You want to see another great example of why Wall Street doesn't support you as an investor and really wants to just support banking? Deutsche Bank's recent upgrade on Cisco systems is a perfect example.
We'll take a look at why we think Wall Street may be wrong again, or specifically, Wall Street may have a specific reason for that recommendation boost that has nothing to do with what you, investors, should do.
Let's talk earnings and favorite pastimes.
So let me just say, earnings
Wall Street
is
2.5x
because their compensation goes up.
Wall Street's wrong again. Deutsche Bank just upgraded Cisco, the network equipment provider's stock, from $65 to $73, and raised its recommendation from hold to buy. So here's the thing. So what's going on? What are they saying? Well, what they're saying is they think that Cisco is all of a sudden going to have mid-single-digit growth. Sounds revolutionary, by the way, for a company that should be benefiting from AI. But because of that mid-single-digit growth, they're really, really bullish on Cisco, so much so that they raised their recommendation from a hold to a buy. Well, let's just look at where Deutsche Bank's stock price is when they raised to $73. Joel, does a raise of a stock price to $73 when the stock's at $65 look like a company that Deutsche Bank thinks is a screaming buy?
So officially, legally, the Wall Street analyst target is the price they believe the stock will be 12 months from now. Well, if it's already $67, I mean, won't inflation and a little cost of capital get me from 67 to 70 plus dollars a share already? So saying this is a buy and raising it as a buy, while at the same time, what we say, Wall Street does a nudge, nudge, wink, wink. It's sort of like, I have to put a buy because the investment banking group is screaming at me. I better put a buy because they're trying to get banking business from Cisco because Cisco does a lot of transactions in the last 10, 20 years. And the bankers want a piece of those transactions, and they don't have to go to the CFO and explain, why does your research analyst have a hold? So they come in, they yell at them, they say, you got to put a buy on it, and analysts across the board will say, okay, that's why it's 100% buy and hold ratings, even though the target prices look like, wishy-washy kind of numbers because they're saying, I have some integrity. I mean, I guess they do have some integrity, Wall Street bankers and analysts, but they have some integrity. And so they say, I'm raising from a hold to a buy. I don't know what the difference is between a hold and a buy anyway. If you're holding the stock, you're long the stock. If you buy, so if you raise from a hold to a buy, does it mean if I'm holding, I should keep it? And if I didn't hold it, then I should buy it? Or anyway, without getting the nonsense of what a buy and a hold means. Yeah,
but I mean, Joel,
this shows how Wall Street's wrong and their own consternation in the job as an analyst.
Right, but I mean, Joel, to your point, what we're really seeing holding on here is probably somebody avoiding a desk clearing. And you want to give everybody, because some people haven't been on Wall Street, you want to explain what a desk clearing means? Because it doesn't mean everybody you get fired. Something different than that.
I don't think they happen anymore, but I will say there are directors of research who are beholden to the bankers, who will walk over to an analyst desk, and after the third time of saying, you better put a buy on this stock, and it's like, well, I'm not sure if I should. And then a day later, it'd really be good for the firm if you put a buy on the stock. And then the third time they don't do it, the director of research would stick out his arm and take everything on the person's desk and knock it on the floor, computers and photos of their family and everything else. That's called a desk clearing. That is a get the heck out of my firm because you're not playing ball with the team. When I was in Wall Street, I remember one of the firms had a compensation program, and the compensation plan for the analyst was, here's how much you get for getting ranked, here's how much you get for whatever, and 30% of their pay was good citizenship. And I remember going to the director of research saying, 30% is good citizenship. What the heck is good citizenship? Really? So this person is getting a bonus of $2.5 million, and a third of that is because they were a good citizen. And what they meant was that they put buys on the stocks they're supposed to be putting buys on when the bankers, because you want to be good citizens, the other side of the room, are actively pitching to that company. And so you see these banking calls all the time where the analyst is begrudgingly saying, okay, I'll put a buy on it. And then their target price is like 10% above where the stock price, has been in the last 52 weeks for a year from now. That's not a real buy. That's a bunch of nonsense.
And look, right, the reason why is because Cisco just made an acquisition in 2024 of $30 billion for Splunk, right? When they made that acquisition of Splunk, guess who wasn't involved? Deutsche Bank. And Deutsche Bank hasn't really been involved in the other 16 total acquisitions that Cisco has done since ChatGPT came out and AI became a real thing, because of the fact that that good citizenship, right, wasn't actually happening. So let's put in perspective really quickly here what it is that the market is pricing in for Cisco and why it is that the analyst, right, by Matt, who's the analyst at Deutsche Bank, may not have been able to get confident raising the stock price, even though his stock price target, even though he gave it a buy. And the reason why is this. So these dark blue bars are what Cisco's uniform cleaned up EPS were for the last 5 years. Those light blue bars, that is what Cisco is forecasted to have for uniform EPS for the next 2 years. When we take Wall Street analyst estimates like Matt's, right, like Deutsche Bank and everybody else, we push them through our database and we clean up the accounting noise. What we can see is basically Wall Street is forecasting earnings are going to be flat for Cisco for the next 2 years. And yet that white bar is what the market is pricing Cisco to do at current $260 billion market cap for Cisco. The market is pricing 83% earnings growth for Cisco over the next few years.
So you understand the dynamic here between investment bankers and Wall Street research inside any firm, let alone at Deutsche Bank. So there is only one way Cisco is going to get a near doubling of earnings, and it's probably going to be through acquisitions. So the bankers know this, that just to maintain the current stock price, they're going to have to grow earnings by that amount, and they're saying, we better start making a lot of acquisitions. The CFO and the CEO know this, and the bankers are drooling, going, ooh, let's help you get those acquisitions. Let's show you how to get it and get our 3 to 7% transaction fee on what be, I don't know, 30, 40, $50 billion of acquisitions that could be made in trying to get to that kind of earnings level, right? Maybe more even, to be blunt, maybe more than that. And so what's 3 to 7% times $50 billion? That's a lot of banker fees, right, for advising on these acquisitions. So Deutsche Bank's sitting here going, we haven't gotten any of this. They're telling the analyst, you better put a buy on that. The analyst says, of course I'll put a buy on it because I'll lose my job if I don't. But at the same time, they're like, but I'm still going to put a target price that's barely above current because I don't know how they're going to possibly achieve this kind of earnings performance. And so it's a little nudge, nudge, wink, wink. I'm going to do what the bankers want. I put a buy on the stock. But meanwhile, I'm going to tell my investors that, oh, by the way, the target price is only like 12% above the current. So that's a year from now. That is the nudge, nudge, wink, wink. That's say one thing on one side of your mouth and say something on the other. And you can see it in the report. It's blasting at you saying, I'm raising from a hold to a buy. But that's only to make the bankers happy. So now at least Deutsche Bank bankers can go and say, see, Cisco, our research analyst likes your stock too.
We're bullish on you.
Right, hoping they'll never look at the target price or won't understand that it's a 12-month target price or the EPS estimates that can't possibly get you to that target price or what have you. But that's why we're saying Wall Street's wrong again, especially on this name. And it's a fun one to see, play through. Right. That said, Rob, can Cisco organically get to that kind of earnings growth?
No, of course not. Right. And so this is the idea, right? We call it Wall Street's wrong again. What we're really trying to highlight is Wall Street might have a reason for telling you buy that has nothing to do with what they're trying to tell you as an investor to do. So just remember that and be a little cautious. So that's today's episode of Altimetry Authority. If you enjoyed this, hit the like and subscribe button, leave us a comment, and come back for next time. Thanks so much, everybody.
Thank you, everyone.